To start with, we will introduce the term market. A market is a group of suppliers and consumers that exchange products and services for an agreed-upon price. Markets can be limited by the geographical boundaries of their products, such as markets for some dairy products. Other products, such as clothes, are not typically geographically constrained. In some markets, the level of concentration is high, where a small number of large firms produces the majority of the market's output. Pharmaceutical companies and aircraft industries are examples of companies that operate in a highly concentrated market. On the other hand, other markets are very fragmented, where a large number of small firms offers the total production. Restaurants and agricultural producers operate in such a market. The interaction between suppliers and consumers depends on the market structure. Economists have identified 4 basic types of market structures, which are perfect competition, monopolistic competition, oligopoly, and monopoly. We will begin with the perfect competition market structure. In this type of structure, producers sell a homogeneous product that does not have any differentiating features. Moreover, no single supplier is large enough to set or change the price of the product. Therefore, due to the high level of competition, profits are limited to the normal profit, which is the required rate of return or the rental cost of capital paid by the firms to borrow money from investors. Despite this, many perfect competition businesses are very profitable. The corn market is an example of a perfectly competitive market. Indeed, most of the commodities markets operate under perfect competition. The second type of market structure is monopolistic competition. In this market structure, the competition is intense among producers of differentiated products. On one hand, the high level of competition is due to the presence of a large number of producers. On the other hand, the monopolistic feature is due to the presence of differentiated products. Producers of differentiated products set prices that are slightly higher than those found in a perfectly competitive market. Firms have some level of pricing power as long as they can convince clients that their products are unique. Clothing and soft drink companies are examples of companies that often rely on strong brand loyalty. Let's now talk about the oligopoly structure. In this structure, only a small number of producers are available to satisfy customers' needs. The firms maintain a high level of pricing power, which in turn affects the levels of production and prices in the whole market. But before any price changes occur, firms must consider the strategies and reactions of their competitors. Therefore, the decisions made by firms in regards to pricing and production levels are interdependent. For example, a change of price by one firm could prompt the same behavior by other firms in the market. Airline, car, oil, and pharmaceutical companies are good examples of firms that operate in oligopoly structures. Moving to the final type of market structure, the monopoly structure. In this structure, the degree of competition is at its lowest since there is only one producer of a product. Therefore, the product typically does not have a good substitute. The monopolist can therefore exercise absolute power over pricing and production. This is why monopolies around the world are often subject to governmental regulations. Local electrical providers are the most common examples of regulated monopolies. The 5 factors that define a particular market structure are: the number and relative size of producers, the level of product differentiation, the pricing power of sellers, the barriers to market entry and exit, and the degree of non-price competition. To learn more about these factors, find the full Introduction to Market Structures video on www.cognivisio.com.